Ladies and gentlemen, welcome back to our channel. Today, we've got a topic that's been making waves in the world of finance, understanding the mechanics of Bitcoin ETF, a step-by-step explanation. If you've ever been curious about what a Bitcoin ETF is and how it works, you're in the right place. We're going to break it down for you step by step, so let's dive right in. Introduction. Alright, before we get into the nitty-gritty of Bitcoin ETFs, let's start with the basics. You've probably heard of Bitcoin, the digital currency that's been making headlines for years. But what exactly is a Bitcoin ETF, and why is it such a hot topic? What is a Bitcoin ETF? First things first, what is a Bitcoin ETF? ETF stands for Exchange Traded Fund. And it's essentially a way for investors to gain exposure to the price movements of Bitcoin without actually owning the cryptocurrency itself. Think of it as a bridge between traditional finance and the world of cryptocurrencies. How does it work? Now, let's talk mechanics. How does a Bitcoin ETF work? Well, it all starts with a financial institution that creates the ETF. They'll purchase a large amount of Bitcoin and then create shares of the ETF that represent ownership in that Bitcoin. These shares are then listed and traded on traditional stock exchanges, making it easy for investors to buy and sell them, just like they would with regular stocks. Advantages of a Bitcoin ETF. So, why would someone choose to invest in a Bitcoin ETF instead of buying Bitcoin directly? There are several advantages. 1. Simplicity. Buying and storing Bitcoin can be complicated and risky. With an ETF, it's as simple as buying shares through your brokerage account. 2. Liquidity. ETF shares can be bought and sold throughout the trading day, offering greater liquidity compared to the cryptocurrency market, which operates 24/7. 3. Regulation. Bitcoin ETFs are regulated financial products, which can provide a level of comfort and security for investors. 4. Diversification. Some Bitcoin ETFs may hold a basket of cryptocurrencies, offering investors exposure to a variety of digital assets. Disadvantages of a Bitcoin ETF. Of course, there are also some disadvantages to consider. 1. Fees. Like any investment product, Bitcoin ETFs come with management fees that can eat into your returns. 2. Custody risk. While Bitcoin itself is stored securely in cold wallets, there's still a risk associated with the custody of the underlying assets by the ETF provider. 3. Market premiums. Discounts. The price of the ETF shares can sometimes deviate from the actual price of Bitcoin, creating premiums or discounts. Conclusion. In conclusion, a Bitcoin ETF is a financial product that allows investors to gain exposure to Bitcoin's price movements without the complexities of owning and managing the cryptocurrency directly. It offers both advantages and disadvantages, and whether it's the right investment for you depends on your individual goals and risk tolerance. That's it for today's video. We hope this step-by-step explanation of Bitcoin ETFs has shed some light on this exciting topic. If you found this information helpful, don't forget to give us a thumbs up and hit that subscribe button for more informative content. And as always, if you have any questions or topics you'd like us to cover, drop them in the comments below. Until next time, stay informed and keep exploring the world of finance with us.